This is Paul Donovan from UBS's Global Economics Department. This is the beginning of the end of the financial crisis. The UBS plan, hereafter referred to as the master plan, was initiated yesterday. We have reiterated all along that we need three key things. First, an injection of capital from governments. Second, an injection of capital that takes place in a systemic way. Third, rate cuts to help borrower balance sheet repair. Yesterday, the United Kingdom government provided points 1 and 2. Point 3 was provided by the central banks of the world. We need the United States to implement points 1 and 2, and we need to see more rate cuts everywhere, and that includes you too, Monsieur Trichet. But this is a plan to save the world. We must not be churlish. We have embarked upon the right path. In the United States, Treasury Secretary Paulson made explicit his recognition of the loophole in the TARP plan. The TARP gives him the authority to spend $700 billion recapitalizing the banks in the same manner as the United Kingdom, not just buying their toxic assets. Indeed, the TARP authorizes him to place the whole $700 billion on a horse race if he thinks that will promote financial stability. The media are now suggesting that a recapitalization plan could be established as soon as next week. The United States would therefore meet conditions 1 and 2 of the master plan. Only Europe lags behind. There is no systemic bailout in Europe, and little prospect of a system-wide bailout for the euro area as a whole. To some extent, this doesn't matter. If there is a systemic bailout in the UK and the US, the global financial system will probably begin to heal. Europe will suffer in a relative sense, but the world will then be on a path toward financial system integrity. It's worth noting in passing that the Fed tossed AIG another $85 billion loan last night, just in case they needed it. It's not just the banks that require cash. There are still some issues worth pointing out. The United States has yet to recapitalize properly. We need to see the structure to be put in place. Support for the wholesale funding market has not yet been implemented, and until it is implemented, wholesale funding is basically shut, with all that implies for the real economy. Finally, and most important of all, none of this, not the capital injections, not the rate cuts, can stop a significant global economic downturn. Implementing the master plan shortens the duration of the downturn. The downturn itself is inevitable. Equities need to price for recession and for a relatively prolonged recession. Normal growth is unlikely to be resumed before 2011. We are also embarking on a considerable period of disinflation. We have never, ever had a banking crisis without disinflation and occasionally deflation. This time is no different. Asian central banks have eased as well overnight. Hong Kong, Korea, and Taiwan all cut. The Bank of Japan has made it clear that it does not intend to ease interest rates, and there would be little point. Rates are too low to make a cut a growth stimulus. Japan has already delevered. The Bank of Japan did say that it might pay interest on reserves held at the BOJ. The Fed started doing that this week. There are a few direct macro consequences from such a move, but it would bring the Bank of Japan into line with all other major central banks. We wrote a primer on central bank balance sheets yesterday, which covered the issue of paying interest rates on reserves. The economic data has continued to be weak. Japan's August machinery orders gave some downside risk to our GDP forecasts, and we're already below consensus in our views. An important read-through for the state of the global economy was the fact that there was weakness in Japan's export-related industries' demand for investment equipment. Australian labour force data was weak, raising the risk of more aggressive rate cuts from the Reserve Bank of Australia, in spite of the 100 basis points that they've already done. But we're getting UK house prices from the Halifax, which are bound to be bad, and a smattering of European price measures. All this data predates the current situation, of course, and so it's somewhat irrelevant. The full horrors of the impact of the credit crunch lie ahead. In financial terms, we have made it through the darkest hours. Economically, the worst is still to come. That's all for today. Have a good day.